Let's talk a little bit more about what we could expect here in 2024 because strategists are turning more bullish on next year. BMO Capital Markets calling for the S&P 500 to hit a record next year, climbing to 5,100 by year end. And the team also seeing a significant rebound in earnings next year with an EPS target of 250. So what are the best ways to play some of these anticipated gains? We're joined by the strategist behind that call, Brian Belski, BMO Capital Markets Chief Investment Strategist, joining us here, first time in our new studio.
Oh my gosh,
at the desk.
So nice.
It is nice, and a great week to have you. You're out with this bullish call right now on the S&P 500 relative to what some of the other strategists out there in the street are anticipating. What's going to drive that momentum?
Well, we can't speak to other people's work. I mean, this is a really hard job. It's a tough gig. And we received a lot of pushback last year when I was the only published strategist that said stocks would be up. And then we raised our target from 4,300 to 4,550 in May. Again, people thought we were crazy. Now we came out at 5,100 and 250 in terms of earnings. And it's not a jump up and down bullish, super bullish call, but I think it's more of a common sense call. Part of our theme is two parts. Number one, 2024 is going to be year two of normalization. It is also year two of the cyclical bull market, part of our 20 to 25 year secular bull market call that's been in place since 2009. So let me kind of take that back. Last year we said 23 was going to be year one of the normalization. What does that look like? High single digit to low double digit performance and earnings growth, multiples from 15 to 18 in a trading range with respect to interest rates, meaning the 10-year Treasury. Quite frankly, I don't care about the Fed funds futures because they've been wrong. And we kind of took a swing at some of the macro investors in our report saying, people have been so macro and quantitatively driven the last, let's say, 3-4 years, and they've been wrong. Aside from 2022, so congratulations, bears are right 3 out of 10 years, and that was one of them. And so we believe that the yeah but bears are going to continue to change their narrative. Oh, this year is going to be the recession, or now what's the new theme? Oh, now the new theme is going to be deflation. So they're continue to spin their web to be bearish the entire time. By the way, you don't buy an economic indicator. And they're trying to make these big market calls. Guess what? The market is a market of stocks. You buy companies. You don't buy GDP. You don't buy ISM. You don't buy this. You buy companies.
Well, then does it even matter if we have a recession?
Well, it's a great question. And there's a very good chance we don't get a technical recession. However, our call is a rhino, recession in name only, meaning growth contracts, but it doesn't become negative. The investors and the consumers are feeling like it's a recession. And we've already pivoted, by the way. The consumers have already pivoted. And then we come out of that, meaning the second half of the year, we'll probably see inflation drop even a little bit more, and maybe growth slows enough for the Fed to say, okay, inflation's cooled, growth has slowed, not become negative, and then the Fed says, we're going to start cutting rates.
So are you in the rolling recessions camp?
We've already seen several rolling recessions within industries, not within the economy, but within industries. Think about energy this year, and energy probably next year. Think of industrials. Think of technology in 2022. Think of financials this year. Talk about a recession. And so you think about that way. Again, when I'm looking at the market, I'm looking at it as a portfolio manager because we have the very good fortune of also running money. And so I look at how stocks fit into sectors and how sectors fit into the market. So as I look for that, I look for outliers. And so I think we're entering a period where I call it the everybody love everybody market, kind of the Jackie Moon, if you know that reference from Semi-Pro. Sorry, it's a little pop culture. Yeah. But anyway, I think we're entering a period. Yeah, I think we're in a period where we want to own large, mid, and small caps together. Everything in moderation. So you want to be overweight financials and tech. Financials are your value/contrarian call. Tech is your growth call. We were here a year ago and said, communication services is going to be the contrarian pick in 2024. Oh, it's only up 54%. 2023, I'm sorry. It was up 54%. So we're going to book our gain there, put it back to neutral. It doesn't mean we don't like those names. It just means that we want to be if you're going to be in a growth sector, let's be in technology because the sector is much more diversified. There's other names that you can pick in there relative to just the communication services area.
So when we talk about your top sectors there, specifically technology, because I think that's the big debate just in terms of what those gains look like from here on out. Given the fact, like you just said, we've had such a phenomenal year when you take a look at a lot of those tech names and some of those communication services names. Within tech, though, what's the catalyst from here on out?
think the catalyst from here is that you've seen, so for instance, in technically the Magnificent Seven, there are only 3 of them are tech stocks. Did you know that? Yeah, so people don't talk about that. I believe that you're starting to see disparity in terms of their valuation and earnings growth within the 7 stocks. So that tells you that I don't think, for instance, Meta is going to be in line with Google next year in terms of performance. We're going to start to see different performance in that. That's number one. Number two, the natural broadening out effect, okay, matching up an NVIDIA share with a Qualcomm share in terms of building your barbell is going to be making more sense because, oh, by the way, stock picking strategies worked in 2023. Okay? And I think as you start to actually look at fundamentals and trust management teams and trust their products, you will see that. I've been doing this for a long time, longer than both of you have been alive. And so if you look at cash flow, free cash flow, balance sheet, and earnings discernibility in small mid-cap stocks, it's the best I've seen in well over 30 years. And everyone's missing it because we're so focused on the Magnificent Seven. But the majority of institutional money managers have underperformed. Hedge funds are dramatically underperformed. They're going to be jumping up and down and doing tantrums here in December trying to get the market to go down. And so I think it's stock picking in technology. You want to be more diversified and then own a little bit of everything.
Okay. A little bit of everything in moderation.
Everything in moderation.
All right.
You can live your life like that, by the way.
This is true. This is true. All right.
Full of advice here this morning on Yahoo Finance.
Always coming in with the wisdom. All right. We want to thank Brian Belski, BMO Capital Markets Chief Investment Strategist, for joining us once again this morning.